This week, Wall Street investors welcomed Dovish remarks over several Fed policymakers. In response, the stock market regained some optimism, taking no notice of geopolitical risks. The market found the light at the end of the tunnel as the Federal Reserve is poised to make a pause. The stock market is occupied by making forecasts so that it neglected the report on the US factory inflation released before the opening bell. The highlight of the day is the minutes of the Federal Open Market Committee. Wall Street found out some other good news on a Tuesday and closed with gains. The S&P 500 rose by 0.52% to close at 4,358 points. The benchmark stock indexes traded in the green in the New York pre-market. The bulls are trying to reinforce a further uptrend by breaking the level of 4,382 points. Dovish comments by several Fed speakers inspired optimism among stock investors and also pushed yields of US Treasuries down. Following the comments by Fed policymakers on a Monday, Atlanta Fed President Raphael Bostic said that the central bank does not find it expedient to raise interest further because there is no threat of a recession. Later that day, Minneapolis Fed President Neel Kashkari noted that the US economy is on the path to a soft landing from his viewpoint. Thus, inflation will be brought down to the 2% target, though unemployment rates will not increase. Though Neel Kashkari said that the recent rally in the US Treasuries yields could negate the agenda for further rate hikes, and he also warned that if yields go up amid revised expectations of the Fed's further policy, the central bank will have to raise interest rates again. Member of the Board of Governors Christopher Waller confirmed that the central bank is adamant to push inflation to the target level to 2% per annum. Despite such cautious comments and the intention to leave leverage for further maneuvers, the market made its conclusion. According to the FedWatch tool, investors assess the scenario of the Fed status quo in November and December at 86 and 73% respectively. And today, the factory inflation data confused the stock indexes for a short while. The data showed stronger than expected factory inflation in September, and this provides an argument for the Federal Reserve to keep interest rates higher for a longer time. The producer price index for end demand grew by 0.5% on months, higher than the projected 0.3% growth. Despite the higher than expected PPI, the reading in September is the lowest in the last 3 months. The market gave a muted response to the report as traders shifted focus to the Fed minutes. Summing up the policy decision at the meeting in September, Jerome Powell confirmed an aggressive stance on monetary policy, and he said that even though people hate high inflation, the question is still open whether the central bank has done its job. The Fed has always been clear about its intentions to raise interest rates as high as necessary and for as long as necessary to tame inflation. October's rally in Treasury yields was enough to prompt some officials, even prominent hawks such as Dallas Fed President Larry Logan, so suggested could mean there is less need for another rate hike in the current cycle. The Fed minutes may not display the viewpoint on how a rise in Treasury yields could influence lending conditions. The thinking is that yields of 10-year Treasuries at that time were 30 points lower than the ones at present. Obviously, traders want to play safe today ahead of the crucial inflation data that is due tomorrow. Investors will be alert to remarks from Christopher Waller, Atlanta Fed President Raphael Bostic, and Boston Fed President Susan Collins. While the stock market is regaining optimism, the US dollar has to defend its advantage. Its index extended losses on Wednesday and dipped to 106.60. The instrument is expected to trade in the intraday corridor between 105.30 and 106.10. The Canadian dollar is sensitive to the dynamic of oil prices on the back of the empty economic calendar for Canada. The USD CAD pair was trading at 1.3590 before the opening bell, and the intraday outlook suggests that the instrument will continue its move in favor of the loonie, with the targets at 1.3570 and 1.3480. Meanwhile, oil prices fell from their recent peaks and are trading steadily, despite the likelihood that the hostilities in Israel and Gaza Strip will spread over to the broader Middle East. Oil prices are nearly 10 and 11% lower from September highs. The crypto market is overwhelmed by pessimism. Popular crypto assets are losing ground. Bitcoin is no exception today. The token slipped by more than 1% to trade at $27,099, and the crypto is making brave efforts to stay above 27,000, trading between $26,900 and $27,200. Bitcoin is ready either to retest 26,600 or to rebound to 27,450. Ethereum stands out among the rest of popular altcoins. The outlook for the token is bullish. Ether is likely to surge by more than 5 times to $8,000 per token by the end of 2026. This optimistic forecast was presented by Standard Chartered. This forecast is due to the fact that Ether is becoming increasingly used in smart contracts, games, and the tokenization of traditional assets. We hope that our daily videos help you figure out what is going on in the markets. We are always open for all your questions and offers. See you online tomorrow.